You think you have complete control over your trading decisions. You analyze charts, study market patterns, follow your strategy to the letter. But what if I told you that while you're focused on technical analysis and fundamental research, there's an invisible force pulling the strings behind every single trade you make? A force so powerful that it can override years of education, sophisticated strategies, and logical reasoning in a matter of seconds. This force doesn't care about your trading plan. It doesn't respect your stop losses or profit targets. It operates faster than conscious thought, flooding your system with chemicals that hijack your decision-making process before you even realize what's happening. Professional traders on Wall Street, hedge fund managers with decades of experience, retail traders who've spent years perfecting their craft, they all fall victim to this same invisible puppet master. The puppet master is your emotions. And the uncomfortable truth is that emotions don't just influence your trading decisions. They control them in ways that most traders never fully understand or acknowledge. Modern neuroscience has revealed something that should terrify every trader. When your brain perceives a threat in the market, it immediately releases stress hormones like cortisol that flood your body with fear signals before you're consciously aware of being afraid. This means your emotional response to a losing trade begins milliseconds before your rational mind can process what's actually happening on the chart. By the time you think you're making a logical decision, your emotions have already taken control of the steering wheel. Think about the last time you held a losing position longer than you should have. You probably told yourself you were being strategic, waiting for the market to turn around, following your analysis. But the real reason you held on wasn't strategy. It was fear. Fear of admitting you were wrong. Fear of taking the loss. Fear of what that loss meant about your abilities as a trader. Your emotions convinced your rational mind to create logical-sounding reasons for an emotionally driven decision. This is how smart traders get outsmarted by their own psychology. Intelligence, education, and experience don't provide immunity against emotional trading. In fact, highly intelligent traders often fall harder because they're better at creating sophisticated rationalizations for emotionally driven decisions. They can construct elaborate analytical frameworks to justify holding losing positions, averaging down on bad trades, or abandoning their risk management rules. The financial markets are fundamentally different from every other arena where intelligence and knowledge typically lead to success. In most professions, being smarter, more educated, and more experienced gives you a significant advantage. But trading is a psychological battlefield where your own mind becomes your greatest enemy. The market doesn't care about your credentials or your IQ. It rewards psychological discipline and punishes emotional reactivity, regardless of how brilliant your analysis might be. Consider what happens in your brain when you see your account balance dropping. The same neural pathways that evolved to keep our ancestors alive when facing physical threats activate when you're facing financial threats. Your brain literally cannot distinguish between a market drawdown and a charging predator. Both trigger the same fight-or-flight response that prioritizes immediate survival over long-term thinking. This biological reality means that every trader, no matter how experienced, is fighting against millions of years of evolutionary programming that's designed to make quick, emotion-based decisions in the face of perceived danger. Your rational mind might understand that a small loss is part of a larger profitable strategy, but your primitive brain is screaming that you're in mortal danger and need to act, and greed are an immediately to survive. Fiat just emotions that occasionally interfere with trading. They're the primary drivers of market behavior, creating cycles that repeat with predictable regularity throughout market history. When fear dominates, traders sell indiscriminately, often at the worst possible times. When greed takes over, they chase profits without regard for risk, buying at tops and holding positions far longer than their strategy dictates. The dot-com bubble of the late 1990s provides a perfect case study of how emotions can override intelligence on a massive scale. Brilliant investors, successful fund managers, and sophisticated institutions all participated in bidding technology stocks to absurd valuations. These weren't uninformed retail traders making rookie mistakes. These were smart, experienced professionals who understood valuation metrics and market dynamics. But greed created a collective delusion that traditional analysis no longer applied to internet companies. During this period, investors abandoned fundamental analysis not because they forgot how to do it, but because their emotions convinced them that old rules didn't apply to the new economy. Greed didn't just affect individual decisions, it created market-wide psychological phenomena that persisted for years, trapping even sophisticated traders who tried to fight against the euphoria. The crash that followed wiped out trillions of dollars and revealed how emotion-driven decision-making creates systematic risks that extend far beyond individual trading accounts. The same smart money that drove prices to unsustainable levels during the bubble became the panicked selling that accelerated the crash. Fear replaced greed as the dominant emotion, but the result was equally destructive to rational decision-making. What makes emotional trading particularly dangerous is that it often feels completely rational in the moment. Your brain is exceptionally skilled at creating logical-sounding explanations for emotionally driven decisions. When you're holding a losing position because you're afraid to take the loss, your mind will generate compelling reasons why the trade is still valid. When you're chasing a momentum play because greed has taken over, you'll find technical patterns and fundamental catalysts that seem to justify the entry. This self-deception is so sophisticated that most traders never recognize when emotions are controlling their decisions. They genuinely believe they're following their strategy and making logical choices, even when they're acting on pure emotional impulse. The rationalization happens so quickly and smoothly that it's nearly impossible to catch in real time without specific training and awareness. Cognitive biases add another layer of emotional interference that smart traders often underestimate. These biases aren't random quirks of human psychology. They're systematic patterns of thinking that affect every trader, regardless of education or experience. Confirmation bias makes you seek information that supports positions you already hold while ignoring contradictory evidence. Anchoring bias causes you to give excessive weight to the first piece of information you encounter, often your entry price, which then distorts every subsequent decision about that trade. Overconfidence bias is particularly treacherous for intelligent traders because early success can create a false sense of mastery. When you have a few winning trades, especially early in your trading career, overconfidence convinces you that you've figured out the market. This leads to larger position sizes, more frequent trading, and abandonment of risk management rules precisely when discipline is most critical. These biases operate below conscious awareness, systematically distorting your perception of market information and trade outcomes. You might think you're conducting thorough analysis, but confirmation bias is filtering the data to support predetermined conclusions. You might believe you're being objective about position sizing, but overconfidence is pushing you toward excessive risk. You might feel like you're making independent decisions, but herd behavior is subtly influencing your choices based on what other traders are doing. The most successful traders aren't those who eliminate emotions entirely. That's impossible for human beings. Instead, they're traders who understand how emotions operate and develop systematic approaches to prevent emotional responses from controlling their trading decisions. They recognize that psychological discipline is more important than analytical brilliance, and they invest as much time developing emotional awareness as they do studying charts and market fundamentals. Understanding how emotions secretly control your trading decisions requires looking deeper into the specific mechanisms that operate beneath conscious awareness. Your brain processes market information through multiple pathways simultaneously, and the emotional pathways consistently arrive at conclusions faster than rational analysis. This speed advantage means that by the time you think you're making a calculated decision, your emotional response has already shaped what information you pay attention to and how you interpret it. The neurochemical reality of trading reveals why even the most disciplined traders eventually succumb to emotional decision-making. Dopamine, the neurotransmitter associated with reward and motivation, doesn't just activate when you make money. It activates in anticipation of making money, creating a powerful feedback loop that can override logical risk assessment. When you see a setup that looks promising, dopamine floods your system before you even enter the trade, influencing your perception of probability and risk in ways that favor taking the position regardless of whether it fits your criteria. This biochemical influence becomes particularly dangerous during winning streaks. Each profitable trade releases more dopamine, creating a neurochemical high that makes you feel invincible. Your brain begins associating trading activity with pleasure, pushing you toward more frequent trading and larger position sizes. The rational part of your mind creates justifications for this increased activity, convincing you that your success proves you've mastered the market. But what's really happening is that dopamine is hijacking your decision-making process, turning disciplined strategy execution into reward-seeking behavior. The flip side occurs during losing streaks when your brain's threat detection system becomes hyperactive. Stress hormones like cortisol remain elevated, keeping you in a constant state of fight or flight arousal that makes calm, analytical thinking nearly impossible. Your perception narrows, focusing intensely on immediate threats, while losing sight of longer-term strategy and probability. This physiological state makes every small loss feel catastrophic, and every winning opportunity seem too risky to pursue. Smart traders often underestimate how profoundly these neurochemical states affect their ability to process information accurately. During high-stress periods, your brain literally changes how it evaluates risk and reward. The prefrontal cortex, responsible for executive function and rational decision-making, becomes less active while the amygdala, your brain's alarm system, becomes hyperactive. This shift means you're physiologically incapable of the same quality of analysis you can perform when emotionally neutral. The most insidious aspect of emotional trading is how it compounds over time. Each emotionally driven decision creates neural pathways that make similar decisions more likely in the future. Your brain learns to associate certain market conditions with specific emotional responses, automating reactions that bypass conscious evaluation. If you panic sold during a previous market dip, your brain creates a pathway linking market volatility with the need for immediate action. The next time volatility spikes, this pathway activates automatically, making panic selling feel like the obvious rational choice. These learned emotional responses become so deeply ingrained that they feel like intuition or market wisdom. Experienced traders often talk about gut feelings or market instincts, but what they're really describing are automated emotional responses based on past experiences. Sometimes these instincts align with profitable decisions, but often they represent emotional patterns that worked in specific past situations but aren't appropriate for current market conditions. The social dimension of emotional trading adds another layer of complexity that individual traders rarely recognize. Markets are fundamentally social environments where collective emotions create feedback loops that can persist for extended periods. When fear dominates market sentiment, individual traders find their own fear amplified by the emotional state of other participants. Social media, financial news, and trading communities all serve as emotional contagion vectors that spread fear, greed, and panic faster than any fundamental information. This emotional contagion operates through mirror neurons in your brain that automatically mimic the emotional states you observe in others. When you see other traders panicking, your own stress response activates even if your personal positions aren't threatened. When you observe others celebrating massive gains, your own GRI feed intensifies even you haven't identified comparable opportunities. This biological mimicry means that emotional trading is never just an individual phenomenon, but a collective behavior pattern that amplifies individual psychological vulnerabilities. Professional traders who work in institutional environments often describe how the emotional atmosphere of a trading floor can override individual discipline. Even traders with years of experience and sophisticated risk management systems find themselves caught up in collective emotional states that push them toward decisions they would never make in isolation. The energy of group panic or euphoria creates a psychological momentum that's extremely difficult to resist, even when you intellectually understand what's happening. The timing of emotional responses creates another critical vulnerability that smart traders consistently underestimate. Emotions don't just influence your decisions randomly. They strike with precise timing at moments when your psychological defenses are weakest. Fear peaks just as markets reach oversold conditions where buying opportunities emerge. Greed intensifies exactly when markets become overbought and due for corrections. This timing isn't coincidental. It reflects how collective emotional patterns create the very market conditions that trigger individual emotional responses. Your brain's pattern recognition system, which serves you well in analyzing charts and identifying setups, becomes a liability when it starts recognizing emotional patterns instead of market patterns. If you've experienced significant losses during previous market downturns, your pattern recognition system will identify similar conditions and automatically trigger defensive responses before you consciously evaluate whether current circumstances actually warrant concern. This emotional pattern matching happens faster than rational analysis and often overrides logical assessment of current market conditions. The most sophisticated traders understand that managing emotions isn't about suppressing feelings or becoming emotionally numb. It's about creating systems that account for emotional responses and prevent them from controlling trading decisions. This requires developing metacognitive awareness, the ability to observe your own thinking processes and recognize when emotions are influencing your judgment. Most traders focus exclusively on analyzing markets while ignoring the need to analyze their own psychological states with equal rigor. Emotional awareness begins with recognizing the physical sensations that accompany different emotional states. Fear often manifests as tension in your chest or stomach, rapid heartbeat, or shallow breathing. Greed frequently creates a sense of urgency, restlessness, or physical excitement that makes patience difficult. These physical signals appear before conscious emotional recognition, providing early warning systems that can alert you to emotional interference before it affects your trading decisions. The relationship between emotional state and risk perception reveals why consistent risk management is so difficult for most traders. When you're emotionally neutral, a 2% account risk might feel appropriate and manageable. But when fear dominates, that same risk level feels terrifying and prompts you to reduce position sizes or avoid trades entirely. Conversely, when greed takes over, 2% feels conservative, pushing you toward larger positions that exceed your risk tolerance. Your emotional state literally changes your perception of what constitutes reasonable risk, making consistent position sizing nearly impossible without systematic approaches that remove discretionary judgment from risk decisions. The paradox of intelligent traders making consistently poor decisions becomes clear when you examine how emotions manipulate the very intelligence that should protect them. High-achieving individuals often possess sophisticated analytical abilities that become weaponized against their own success. When greed takes hold, brilliant minds don't abandon analysis entirely. Instead, they redirect their analytical power toward justifying emotionally driven decisions with elaborate theoretical frameworks that sound completely rational. Consider a trader with an MBA from a prestigious university who's built complex models for evaluating market opportunities. When this trader spots what appears to be a breakout setup, their emotional system floods them with excitement and anticipation before their analytical mind finishes processing the data. But rather than recognizing this emotional interference, their intelligence kicks into overdrive to support the predetermined emotional conclusion. They'll find supporting technical indicators, construct fundamental narratives, and calculate risk-reward ratios that all point toward taking the trade. What makes this particularly dangerous is that the analysis itself is often technically correct. The indicators they've identified really are bullish. The fundamental story they've constructed has logical merit. The risk-reward calculation follows proper methodology. But the entire analytical process was unconsciously designed to reach a conclusion their emotions had already made. Their intelligence became a sophisticated tool for emotional self-deception, rather than objective market evaluation. This dynamic explains why traditional trading education often fails to produce consistently profitable traders. Most educational approaches focus on improving analytical skills, teaching better technical analysis methods, or providing more sophisticated fundamental analysis frameworks. But enhanced analytical ability without emotional awareness often makes the problem worse by giving traders more powerful tools for rationalization. The market's feedback mechanism compounds this issue by occasionally rewarding emotionally driven decisions. When a trade entered, primarily due to greed or fear, happens to be profitable, it reinforces the neural pathways that led to that decision. Your brain interprets the profit as validation of the decision-making process, making similar emotional reactions more likely in future situations. This intermittent reinforcement creates some of the strongest psychological conditioning patterns known to behavioral science. Professional poker players understand this psychological trap better than most traders. They recognize that short-term results provide almost no information about decision quality. A perfectly played hand can lose money, while a terrible decision can generate profits. The key to long-term success lies in maintaining process discipline regardless of immediate outcomes. Yet traders consistently fall into the trap of evaluating decisions based on results rather than process, allowing profitable emotional trades to reinforce destructive patterns. The illusion of control represents another sophisticated form of emotional manipulation that particularly affects intelligent traders. Markets are inherently uncertain environments where outcomes depend on countless variables beyond any individual trader's influence. But human psychology craves control and certainty, especially in high-stakes situations. Emotions exploit this need by creating false certainty that feels like genuine insight. When you're emotionally invested in a trade, your brain selectively highlights information that suggests you have more control over the outcome than actually exists. You focus intensely on technical levels you believe will hold or break, economic data releases that should move the market in your favor, or chart patterns that seem to predict future price movement. This selective attention creates an illusion that you've identified the key variables determining success, when in reality you're simply focusing on the subset of information that makes you feel most in control. The sophistication of this illusion increases with trading experience and knowledge. Beginning traders might base their sense of control on simple moving average crossovers or basic support and resistance levels. Advanced traders develop much more elaborate control narratives involving complex technical confluences, sophisticated fundamental analysis, and multi-time frame confirmation signals. But both groups are engaging in the same psychological process of creating false emotional discertainty to manage comfort with uncertainty. Market timing becomes particularly susceptible to emotional manipulation disguised as analytical precision. The desire to enter and exit positions at optimal moments triggers intense focus on short-term price movements that feel predictable but largely random. Your emotional system craves the satisfaction of perfect timing, pushing you to see patterns and signals that aren't actually there. Intelligence amplifies this problem by enabling you to construct increasingly complex timing systems that feel scientific but are actually elaborate emotional comfort mechanisms. The professional trading environment reveals how institutional structures can either amplify or mitigate emotional trading patterns. Individual retail traders operating in isolation often struggle with emotional discipline because they lack external accountability and feedback systems. But institutional traders face different emotional pressures related to performance measurement, peer comparison, and career security that can be equally destructive to rational decision-making. Monthly or quarterly performance reviews create artificial time horizons that conflict with optimal trading strategies. When a trader knows their performance will be evaluated at month end, this knowledge unconsciously influences decision-making throughout the month. Losing trades near evaluation periods create intense pressure to recover losses quickly, leading to increased risk-taking and abandonment of systematic approaches. Winning trades near evaluation periods tempt traders to lock in profits prematurely to ensure positive performance numbers, regardless of whether the trade's original profit targets have been reached. The social dynamics within trading firms create additional emotional pressures that intelligent traders often underestimate. Competition between traders, stories of exceptional performance by colleagues, and the visibility of others' profit and loss statements all serve as emotional triggers that can override individual discipline. A trader might maintain perfect emotional control when operating in isolation, but watching a colleague generate massive profits from a high-risk strategy creates psychological pressure to abandon conservative approaches. Technology has introduced new dimensions of emotional manipulation that weren't present in traditional trading environments. Real-time profit and loss displays, instant notification systems, and constant market data streams create a psychological environment of continuous stimulation and response. Your brain never gets the opportunity to settle into neutral emotional states because new information is constantly arriving that requires evaluation and potential action. The gamification elements built into many modern trading platforms exploit known psychological vulnerabilities to increase trading activity. Features like achievement badges for trade volume, leaderboards comparing performance to other users, and social feeds displaying others' trades all trigger competitive and social emotions that have nothing to do with profitable trading strategies. These elements are specifically designed to increase engagement and transaction volume, not to improve trading results. The speed of modern markets creates additional emotional pressures that didn't exist when trades were executed by phone or physical delivery of orders. When positions can be entered and exited within seconds, the temptation to act on every emotional impulse becomes almost irresistible. The friction that once existed between having a trading idea and implementing it provided natural cooling-off periods that allowed rational evaluation. Today's frictionless execution environment removes these built-in safeguards, making emotional trading faster and more frequent than ever before. The complexity of available trading instruments has also evolved to exploit emotional vulnerabilities in increasingly sophisticated ways. Option strategies, leveraged products, and complex derivatives often appeal to emotions rather than logical risk-return analysis. The possibility of large returns from small investments triggers greed responses that override careful evaluation of the risks involved. Marketing for these products specifically targets emotional desires for quick wealth rather than providing balanced risk assessment. Social media has created unprecedented opportunities for emotional contagion to spread throughout trading communities. Real-time sharing of trades, immediate feedback through likes and comments, and exposure to carefully curated success stories all contribute to emotional states that influence trading decisions. The fear of missing out on opportunities that others are capitalizing on, or the greed triggered by seeing others' apparent success, spreads through social networks faster than any rational analysis of market conditions. The psychological impact of information overload cannot be understated in modern trading environments. The human brain evolved to process relatively small amounts of information from immediate environments, but today's traders are bombarded with data streams from global markets, economic indicators, corporate announcements, and social sentiment indicators. This information overflow creates a constant state of partial overwhelm that makes emotional decision-making more likely than careful analytical processing. Pattern recognition systems that serve traders well in stable market environments become emotional traps during periods of regime change or unusual market conditions. Your brain's pattern matching abilities identify similarities to past situations and automatically apply emotional responses that were appropriate for previous circumstances but may be completely inappropriate for current conditions. The 2008 financial crisis, the 2020 pandemic market crash, and other extraordinary market events reveal how pattern-based emotional responses can be catastrophically wrong when market dynamics shift fundamentally. The relationship between market volatility and emotional intensity creates predictable cycles that smart traders can learn to recognize and manage. High volatility periods trigger more intense emotional responses, making disciplined decision-making more difficult precisely when it's most important. Low volatility periods can create complacency and overconfidence that lead to inadequate risk preparation for inevitable volatility increases. Understanding these emotional volatility cycles allows traders to adjust their approach proactively, rather than reactively responding to emotional states after they've already influenced decision-making. The neuroscience research on financial decision-making continues to reveal new insights into how emotions control trading behavior at levels below conscious awareness. Brain imaging studies show that successful traders don't eliminate emotional responses, but rather develop better regulatory control over how emotions influence their actions. This regulation happens through strengthened connections between the prefrontal cortex and limbic system, allowing rational evaluation to occur even when emotional systems are highly activated. The genetic research on Wall Street traders reveals an uncomfortable truth that challenges everything most people believe about trading success. Scientists studying professional traders discovered that the most successful ones don't have genes associated with extreme risk-taking or complete risk aversion. Instead, they possess genetic variants that produce moderate levels of dopamine in their brains. This finding suggests that optimal trading performance requires a neurochemical balance that most people simply don't possess naturally. This genetic reality means that some individuals are biochemically predisposed to make better trading decisions under stress, while others are fighting against their own biology every time they place a trade. The traders with optimal genetic profiles don't experience the same intensity of fear during losses or the same overwhelming greed during winning streaks. Their brains naturally maintain the emotional equilibrium that others must struggle to achieve through discipline and training. But genetics isn't destiny. The brain's neuroplasticity allows traders to literally rewire their emotional responses through consistent practice and awareness. Every time you recognize an emotional impulse and choose not to act on it, you strengthen the neural pathways that support rational decision-making. Every time you follow your trading plan despite feeling fear or greed, you're building the mental infrastructure that separates consistently profitable traders from those who remain trapped by their emotions. The measurement of market emotions has become increasingly sophisticated through sentiment indicators that track collective psychological states. The Fear and Greed Index, which measures market sentiment on a scale from extreme fear to extreme greed, reveals how predictably emotions drive market cycles. When the index shows extreme fear, it often signals buying opportunities as panicked. Selling creates oversold conditions. When it registers extreme greed, it frequently precedes market corrections as euphoric buying pushes prices beyond sustainable levels. These sentiment extremes create the foundation for contrarian trading strategies that profit from others' emotional mistakes. While the majority of traders are selling in panic during fear extremes, Disciplined traders are identifying undervalued opportunities. While others are chasing momentum during greed extremes, experienced traders are preparing for inevitable reversals. The key insight is that market emotions are predictable and cyclical, creating consistent opportunities for those who can maintain emotional independence from the crowd. The practical challenge lies in developing the psychological infrastructure to act against your own emotional impulses and the emotional momentum of the market. This requires creating systematic approaches that remove discretionary emotional decision-making from critical trading functions. Position sizing must be calculated mathematically, rather than based on how confident you feel about a trade. Entry and exit signals must be defined precisely, rather than left to emotional interpretation of market conditions. The uncomfortable truth is that your emotions will always be present in your trading decisions. The question isn't whether they'll influence you, but whether you'll recognize their influence before it destroys your account. Every profitable trader has learned to see their emotions not as enemies to be defeated, but as predictable forces to be managed and channeled. They've built systems that account for fear, greed, and overconfidence rather than pretending these forces don't exist. The market will continue rewarding those who master their internal psychology, while punishing those who remain slaves to their emotional impulses. Your technical analysis means nothing if you can't execute it with discipline. Your strategy is worthless if emotions override it when the pressure builds. The trader who survives and thrives is the one who understands that the real battle isn't against the market. It's against the primitive emotional systems in your own brain that evolved millions of years before financial markets existed. Master that internal battle and you'll finally have the edge that no amount of analysis alone can provide.